Hi everyone, it's Dr. Mike. I'm here at Exit Realty Northwest. This is my colleague Glenn Marino, and we are here once again with a
Tip of the week.
Hey Glenn, I've gone through 2 closings this week. I have many buyers. It's a crazy buying season this year. And I get buyers who, when we talked last tip about down payment assistance, I get buyers who ask about things like interest rates and who pays closing costs.
Absolutely.
That's another that affects how much money a buyer's got to bring to the table to actually buy a house. It's a big consideration. So that's what our tip of the week is. This is just a quick view of all the things that happen in a contract. All these items are things that somebody pays for, either the seller or the buyer pays for. Who pays closing costs and at what interest rate you get is dependent on certain kinds of answers. And I've got the great Glenn Marino to help us break that down for you right now.
Absolutely. After we get past the down payment, which there's really 4 buckets of cash that one must assemble in any real estate transaction.
Right.
Last week we talked about down payment assistance.
Correct. You need a down payment.
Bucket number 2 is closing costs.
Yep.
Bucket number 3 is what we call your escrows that you have to set up for your real estate taxes and your homeowner's insurance.
Exactly.
And then some loan programs require a 4th bucket called cash reserves. We don't see it so much in residential on single-family primary residences, but when investors are buying property, they typically might have to have anywhere from 3 to 6 months worth of mortgage payments and cash
Correct.
reserves. So today we're really going to talk about, real quickly, about closing costs. And I brought today the magic whiteboard once again, Michael. And today we're going to be talking about who pays the closing costs. And we've got 3 strategies that you and I have put together. And the first strategy is the buyer pays the closing costs, meaning you. Depending upon your credit score, the higher your credit score, the lower your interest rate.
Exactly.
So if we assume that in today's marketplace that you're buying a $200,000 home and that your interest rate, you have a good credit score that you could pay, say, 3.5% or receive a 3.5% interest rate, you would be paying approximately $3,500 in closing costs, which, as Michael showed you on that paper, includes all these little items like appraisal fees and credit report fees, underwriting fees, processing. The list goes on and on, but it accumulates to about $3,500.
Sure does.
So that's one strategy. Get yourself the lowest interest rate, you pay the closing costs.
Right.
But let's just say that you're a typical person that says, I really scrimped and saved to get that down payment together. I don't have all that money, that another $3,500 for closing costs.
Correct.
Is there another strategy that I can employ? Can you advise me, Michael, on what I could do? So we move over to strategy number 2.
Yep.
The seller pays the closing costs. And so in this strategy, again, your interest rate would remain the same at 3.5%.
Correct.
However, they would use the services of the real estate professional, such as yourself.
Yep.
And you got to remember, the real estate professional that represents the buyer is the one that inks the contract, puts the terms into the purchase contract.
Yes.
And so you've done this before where somebody has said, you know what? I need the seller to pay the closing costs. You guys have already set the table of expectation. It's a $200,000 purchase.
Right.
And before you ink it, you've picked up the phone, you've called back to the other side and said, my client doesn't want to pay $200,000. With a little at the other end of the phone, they say, now what does your client want to do? And all of a sudden you say, well, they want to pay more. They want to pay $203,500, provided that the seller will pay $3,500 toward the closing costs,
Correct.
which brings that bucket to 0 for our client.
Exactly.
And then
I just did the strategy with my most recent buyer. We did exactly this. Not these amounts, but exactly this strategy. We did exactly this.
And it worked. It worked.
They're
well.
getting money back in the pocket, and the seller, you're about to say it, the seller's still going to get what they expect, actually a little more than they expected.
And that's exactly it. When the seller receives that notice that that the buyer wants to pay more, they go back to their CPA, they go back to their attorney, they go back to their spouse, and say, we agreed on $200,000. They're offering $203,500, but we got to give up $3,500. And when you do the
What
math,
does that mean?
it nets out to $200,000.
Oh, I get my 200 grand.
And so everybody's happy in the
Right.
transaction. The third strategy that someone can employ to pay closing costs is that the lender pays the closing costs.
This isn't, people don't think about this one very much,
Absolutely.
but it's important.
And again, how do we get the lender to pay those closing costs?
It's not easy, I can tell you.
What we end up doing is you have to offer a premium rate or be willing to accept a premium rate. If your rate is typically 3.5%, if you're willing to pay a premium interest rate, any premium will in turn accumulate dollars, funds, a credit back from the lender.
There you go.
In today's mortgage market, any credit for a premium interest rate must go to the buyer that can be used toward the closing costs.
Awesome.
So if here we're in our example, there's 75 basis points, the rate's going from 3.5 to 4.25. The thousands of dollars that would then be available from the secondary market for delivering a premium note at 4.25 when the market's only 3.5, that thousands of dollars would only be attributable to the buyer,
Goes to the buyer.
which then would go toward their closing costs.
Got it.
So once again, using, looking at the interest rates, we would get enough credit so that the closing costs were zero. They would pay a premium interest rate, which again, their mortgage payment would go up negligibly.
How much do you think? We're talking like tens of dollars. It's a 30-year note.
We're probably talking anywhere
Half a
here,
percent.
we're talking about anywhere from $50 to $75.
So it'll affect you. You pay more in each payment rather than all out of pocket.
Correct.
That's all.
But
$40.
it gets them to the closing table.
Correct.
Because they don't have $3,500 today
Right.
to bring to the table.
Money in your pocket.
Correct. And your purchase price?
Still the 200,000.
Still the 200,000. So again, 3 different strategies. You need to get together with your real estate professional, Dr. Michael. He'll go through the 3 strategies. Obviously, once you guys decided, you can get actual quotes, actual payment information from me over at First Centennial Mortgage, located in Naperville, Illinois.
What I love about this, Glenn, because we brought up last week about and we advertise it, you can buy a house with 1% down or $1,000.
Correct.
And that's true given some of these strategies, because there are extra things that come in after you have your down payment, whether you're getting down payment assistance or what. The answer to whether you can buy a house for 1% down is dependent on people who are professional about it and can bring these kinds of strategies to you. And it's what you have ready in your pockets. If you've only got $1,000 or only have 1%, can you still buy a house? The answer is yes.
Absolutely.
Using some of these
We're going to
strategies.
need to use these strategies. So again, don't let closing costs be the reason you don't purchase a house.
There you go.
We will be back here next week for another Tip of the Week. Have a great day.